Good afternoon, everyone. This is Molly Hill from Blue Cow Software. Before we get started today, I just want to do a quick sound check. So if you can hear me, can you please raise your hand on your little screen? Perfect. Great. Thank you, everyone. Today's webinar will be presented by Joe Ciccarello and Marty Kirshner of Gray, Gray & Gray. Before we get started, I'll just provide you with some background information on their company. Gray, Gray & Gray is synonymous with oil heat accounting and financial management. When the firm was founded in 1945, one of their first clients was an oil heat dealer, a client with whom they still work today. Over the years, Gray, Gray & Gray has been established as the go-to accounting firm for dealers who want to grow their business profitably. This afternoon, Joe and Marty will be providing some inside information on how your business can compete during the upcoming heating season. They will talk about the best practices the industry's most successful dealers are using to boost their margins and maximize profitability. In addition, Joe and Marty will touch on some of the big changes in taxes that are occurring this year and the steps you will need to take to ensure your business is in compliance. I'm pleased to turn over the control of your screen to Joe Ciccarello and Marty Kirshner of Gray, Gray & Gray, Certified Public Accountants.
Thank you very much, Molly. Appreciate that introduction. My name is Marty Kirshner. I'm here with Joe Ciccarello. He is the managing partner at Gray, Gray & Gray. I am a supervisor here. And like Molly said, we're here to talk about what your competition is doing. As Molly also mentioned, we do consider ourselves the accountant for the oil and energy industry, and because of that, we have access to a lot of resources and information which we're able to pull together and share with you guys so that we can kind of give you, an inside tip on what, your competitors are doing without obviously giving away confidential information, of course. But I think today we're just going to kind of go through some things that we see in our clients and what the industry is doing, and because of that, we can share that with you, and we'll take you through the day. So basically what we want to run through in today's presentation is to give you a general idea of, best practices in the oil heat industry, what we see clients doing that they seem to be succeeding with, some management and marketing trends that are showing their face in the workplace, and specifically with that, we're going to talk about the importance of developing a strategic plan. We're going to give a little insight into managing cash flow and collections and dealing with, the problematic customer. We'll then get into talking about margins and targeting margins and what actual margins are and how to improve your margins. Then we're going to do some discussion on industry standards with regards to, compensation of how certain employees are compensated, whether it's service techs, delivery drivers, customer service reps. Again, a lot of the information that we're going to share comes from our annual survey, which is actually available at our website, which we will, I think, share with you at the end. And then lastly, we'll just real briefly go over some year-end tax planning tips, things that you should be aware of going into 2013 and 2014, so changes that obviously can affect what your bottom line is and what will end up in your pocket.
Okay. Yes, good afternoon. With regards to some of the tools that we use to come up with these best practices, which the firm has implemented over the years, one of them is our annual survey, and I'm not sure how many years we've been doing that, but that goes now back quite a number of years, where on an annual basis we survey most of the heating oil companies up and down the Atlantic coast, the Northeast, and just to get a good handle on what has been happening with them in the last 12 months. We also have created a product that we call it a fuel track, which is a management report that we use in conjunction with our financial statements, and we use it to compare your company with your competition. as you are well aware, most companies in this space are privately held companies, and therefore good information is very hard to come by. Yeah, you can compare to yourself on how well you did last year, or from time to time when the business owners find themselves at some association meetings, they may be talking about margins or whatever. But it was very hard for the company. They wanted to find out how well they were doing against their competitors to really have a handle on that. And so a number of years ago, we created this report, which we call it Fuel Track, and it's a report that is generated from our database where we have all kinds of companies, some of them our clients, some of them not our clients, but we have their authority, and we are authorized to use their financial information for this purpose, so that then we can create reports, and we can create these reports and narrow them down to location and size, and also if they have propane or if it's full service or something less than full service. And that when we do that, then we are really able to compare and to really discuss with the management team what is it, why is it that your expenses, or let's say your operating expenses, are as high as they are, or why is it that your margins are not what they should be? Why is it that your service department it's not as profitable? Is it the labor? Is the material? Is it the overhead? All kinds of questions which are very important to get the answers to, and questions that, when answered and timely answered, are going to make the difference between having a good year or not having a good year, and ultimately is surviving in this market space or not surviving.
Yeah. So with that, you know, the things that you need to do in order to stay ahead of the game or just to stay afloat, we came up with some best practices that we advise our clients to do and that we've seen them do. And, you know, some of the obvious things, it's budgeting, it's planning ahead, it's knowing, you know, how much do I need to sell and at what price do I need to sell to make this profit, or to be able to take, as an owner, take this much money out of the company. But to get there, you also need to really have an understanding of what are your cost of sales versus operating costs. And we've seen a lot of clients struggle with understanding what is a cost of sale versus an operating cost. A cost of sale is any cost that goes into delivering that product to the consumer's house or performing that service. An operating cost is just an overhead cost that, you know, the cost of running the general business. And we'll get into examples of that in a couple minutes. The next thing we advise clients to do is to come up with a break-even analysis. This is a very important calculation that you should come up with, which we will show you how to do. And that's calculating exactly how many gallons do I need to sell to break even. Or you can play around with the calculation. If I want to make X dollars, how many gallons do I need to sell? Or at what margin do I need to sell these gallons at in order to break even? And so that's a very important tool, because that's going to be what determines your future. That's how you're going to plan ahead, especially as you gear up for this next heating season. Figure out how many gallons do I need to sell to stay profitable. We'll also walk you through an exercise on calculating your cost per delivery, calculating your cost per your service call, the importance of knowing how to break out each cost by a profit center. I mean, the biggest thing to do here is, when we talk about this, is to understand that you need to treat each segment of your business individually. There needs to be the fuel oil line. There needs to be the service line. If there's a propane line, those all need to be separate. And then, you know, we'll get into overhead and how that is factored into each department. But, you know, in order to really do budgeting, you need to know how each product line is doing, because you need to know if there's one line that's holding up the rest of the group. And lastly, as we mentioned, and you'll see it as a recurring theme, is develop a strategic plan. You know, that's the best practice right now in an industry that's ever so changing, ever so quickly, with the invasion of natural gas and the pipelines coming in. It really is important to develop a strategic plan and determine where your company is going to be now and where it's going to be 5 years from now. And again, as Joe mentioned, our Fuel Track 5-speed is an exercise that we've been running with our clients to help them develop their strategic plan and get them going into the future.
Yes, the strategic plan is something that now, for the last 2 years, we really have invested heavily into bringing this development to our client base, because we feel that meaning the heating oil industry or the energy industry, is at a crossroad. It is the same kind of events that probably were experienced 50, 60 years ago when companies changed from coal to oil, and even before that. It's a generational change, and therefore companies have to be ready to take a look and see what is happening in the marketplace, see what's happening to the heating oil, and as a fuel, as a heating fuel, and then strategically plan for the next 5 years. What is your company going to look like 5 years from now? Are you going to continue to still be doing what you're doing today? Probably not. Most likely not. I doubt it very much you will. So what is it that you will be doing? How are you going to be replacing those the revenue, the lost revenue that comes from your customers converting to propane or to converting to natural gas? How are you going to be replacing the lost gallons due to conservation and to the fact that your equipment now, or the equipment at your customers' homes, is newer and more efficient? How are you going to replace the number of gallons that are going to be reduced because of the fuel additives? All these, when taken together, are going to create a sense that the changes need to be made, that additional revenue needs to be brought in. And that's when we, as advisors to our clients, come in and we have an off-site meeting somewhere with the management team, and when we say that there is no idea is too dumb or too stupid to really entertain, and let's figure out what is it that you could be selling to your best assets, and your best assets are your customer list. What is that your customers are telling you that they're going to be wanting from you in the future?
So, as we mentioned, the first thing that we talked about was budgeting and the importance of it, and setting, goals for the immediate future. We mentioned how, budgeting by department is critical because, again, you need to know how much you need to make versus how much you want to make, and you need to obviously have a long-term view of where you want to be at the end of each season, at the end of each year, because if you try to make decisions based on the immediate future, you can't predict the weather, and you can't always predict the activity of your customer base, so you always need to be one step ahead. We also talk about, the key financial indicators of success is knowing how good your margins are, knowing how much cash flow you're generating, and we're going to get into, maintaining good cash flow and things to keep track of, and knowing your costs. And then, as I mentioned too, accountability within each department. As I mentioned before, the industry's changing, and a lot of the companies used to be fuel companies that could do service at a loss just to maintain that customer. And as you're seeing now, with the way things are going and the way margins have been shrinking over the years, you're going to find yourself becoming a service company that just happens to deliver oil. And you need to adapt to that and adjust to the ways of the way the world's changing with that. And we've said to our clients, in order to do that, if you want to be a service company, you have to offer a variety of services, which involves diversifying, which again we will get into later on.
So in order for us to really start discussing the budgeting process, we need to get on the same page with regards to how we are going to classify your operating expenses, and we want to have consistency, because what we have found when we first started reporting to management on this 5-speed or the fuel track report is that people were calling different things, and they were including in cost of goods sold items that some other companies were not, and therefore whenever we were trying to compare, it was always an issue. Well, I have these costs in my cost of goods sold calculation, does my competitor does, and so on and so forth. Or my competitor does not have it, or I have it. So we kind of tried to standardize the process and came up with certain with a method to really calculate cost of goods sold and what should be included in cost of goods sold, so that all companies that we work with are using, and also that we also have it for when we prepare a fuel track report for non-clients. We just know, okay, these are the items that we have to include, these are the items that should not be included, so that we can come up with something, that a factor that can be compared. And here is what we're going to be getting into.
So the thing with cost of goods sold is, as I mentioned, you need to keep track of cost of goods sold on a department basis, and also think about your cost of goods sold, because again, these are the costs of making the sale happen. Without these costs, you can't generate revenues. And we believe that if clients adopt this kind of rule of thumb for these costs, then it'd be easier to compare apples to apples and, you know, match you up with a company like SizeSteers. But these are really all-inclusive and should be delivered to profit centers. So we just talked about, I mean, the basic obvious one is fuel purchases. Obviously, when you buy something versus what you sell it for, that's what your margin is. But then there's costs that take it a step further, because there's other costs in making that sale happen, which is getting that fuel from where you bought it from and into that customer house. So you obviously have, you know, the driver's wages, the payroll taxes, and the benefits related to that. There's insuring those trucks. And one of the biggest expenses that goes into it is any vehicle maintenance expense on those trucks, which seems to always find its way below the line. But that really is a cost of delivering that good, because you need to fuel that truck, you need to maintain that truck, and trucks have wear and tear just like anything else. But if that truck's not working, it's not going to make that sale for you. So it really is a cost of getting everything done. So if you kind of look at this and picture an income statement, these are all the expenses that should really go above the line and evaluated on a departmental basis. As you can see in here too, we have material purchase and parts for the service department, and we have service tech, drivers and wages, and then you need to kind of break out within your auto expenses what expenses relate to my delivery trucks versus what expenses relate to my service trucks, and, you know, break those down by profit center so that you can really get comfortable with your gross profit on each department.
The comment here that I would like to make is that whenever we talk about margins, and whenever we talk to clients or to people in the industry, that what comes to mind right away, or what they always talk about, is margins. And margins great, because what margins is really is how much you are buying the fuel for, and what it's costing that same fuel. Sometimes they do have delivery costs in there, but most of the time they do not. And therefore, it is a good barometer. But when you're also using that information with the banker, that is definitely a misunderstanding, because that's not what the banker is used to seeing. That the banker is more interested in getting a cost of goods sold which is fully loaded. That's to them what that means. Not margins, but cost of goods sold. So when we're talking to dealers, they like to talk about margins and saying, my margins are 87 cents, 75 cents, and whatever. And that's all good and well said, but whenever you're talking to anybody other than somebody who's in the industry, that really doesn't mean anything. Now we've got to talk about as a percentage of revenue, and what is it, the gross margins, which is your sales less cost of goods sold, is as a percentage of revenue. And that's where sometimes we have some misunderstandings, and we have to be sure that it is clarified and it is well explained. And as Marty alluded to, that also that you know, calculating a gross margin or cost of goods sold company-wide doesn't really tell you a whole lot. You think about it, what you're doing is you're mixing all kinds of apples and oranges, whether it's fuel oil, propane, service, installation, other, and then and that's all your total revenue. And then all those cost of goods sold, which could be parts, products, so on, and payroll and so forth, and come up with a percentage of revenue. But that's if you then try to make some sense out of that, it really wouldn't tell you anything. And the exercise that needs to be done is to break that down by the various components, treating each each profit center as or each item as its own profit center and calculate it as such, so that you would have a gross profit for the fuel oil or for the propane or for the service department or for the installation department. And then you can go a step further and start comparing and see how you're doing and see where you need to focus to make sure that it's brought in line.
Which takes us to the next part of the equation, which is your overhead costs. And these are the costs that really are costs of, keeping the company running. Your overhead costs, as they're commonly referred to, which, is like your rent, your utilities, your general insurance, your real estate taxes, repairs and maintenance on non-delivery or service items. And the thing with overhead costs is it's really hard to determine what you can sustain on your overhead costs if you don't know how much margin or gross profit you're making on selling the goods. And a lot of times when we're sitting down with clients and going over their expenses and benchmarking them with their like-sized companies, we find that these operating expenses are the best place to look on why the company might be losing money. I mean, we've had clients of similar size that do exactly the same thing but might have a couple $100,000 more in payroll than the other company and not know that they're overpaying the industry standard, and if they may need to shed someone, or maybe some of their employees aren't being fully utilized. Maybe a company is spending too much time on advertising and not generating new clients out of it or new customers, or they're overspending on office expenses. Anything below the line is the easiest place to tweak, because when you start talking about tweaking your costs above the line, that means you're either pinching your margin or you could be compromising the service, because you could be cutting the labor of an employee, and now you have one less person delivering oil. So really, starting with overhead costs is the best place to start when you're looking at cost-cutting decisions.
And that's the reason why also operating costs should be looked at as firm-wide and not by the various departments. Usually, the operating costs are allocated to the departments via some form of an allocation, whether it's based on revenue, based on payroll, so on and so forth. And a lot of people do not feel that there is a lot of savings in individual items on your operating costs, whether it's office expenses, whether it's general insurance, whether it's uniforms, so on and so forth. But that's when we have found that really a significant amount of dollars can be found in these areas, because these are the areas that usually are not well tracked, and the budget for the following year is usually done by looking how much was spent the previous year, and has a tendency to keep growing until somebody really takes the time and looks into any given item and saying, okay, why are we spending such dollars for whatever the item is? And when you do that, that's a very important exercise that we always ask our client's accountant or office manager to do that. And my past experience has been that in insurance, whether it's liability insurance, there has been significant savings, and that goes because the business owner is a pretty loyal individual and has been using the same insurance agency for so many years, and after a while, it is a possibility that that policy hasn't been shopped anymore and gets automatically renewed. And guess what? There may be somebody out there who could be doing it for less. The same goes with a lot of other expenses where, there hasn't been really the time allocated to make sure that that you're getting the best value for what you're paying. It's definitely an area that we tell our clients to look at, and to before you do the budget for the following year, analyze line item by line item. Know exactly what you're going to be spending in every one of these items.
So then now we're just, this is just taking everything back to the basics. This is looking at what the income statement should look like. And as you can see, you take your sales less your purchases, which is your cost of oil or your cost of material, and that's your gross margin. And then we take out our delivery and driver costs, and there's our gross profit. And then, again, your overhead and administrative expenses. What this is showing you is in total, but what you really should be doing is doing this for each department and, allocating your overhead expenses if you need to come up with whether or not each division is profitable. And I know this is all seems like really basic stuff, but if you are misallocating the expenses to the wrong place or not putting them in the right place, you're really not gauging your true gross profit or your true margin, and then it makes it that much harder to budget. So all we're trying to do is just convey a message of here's really how it should be, and if you follow this rule of thumb, I'm not saying it's the only way to go, but this could help you really determine what your gross profit is and then help you budget on the next few calculations that we're going to show you.
And notice that one thing we've done is that we pulled out the owner's salary, and that's because what we find is, that our clients are closely held businesses, and as you may well know, in a closely held business, the owner is usually the last individual to get paid. And if things are going well and it's a good year, the owner may be making a little bit more. But if things are not going well and there needs to be done, some cutting to be done, usually what happens is that by the time things are really taken into consideration and looked over, it is the owner's salary that it gets reduced so that the budget can be met. And what we wanted to do is to pull that out as a separate item because it definitely needs a discussion on its own. In as such, every decision that it's made, regardless of big or small, it's going to have an impact on that number. And that goes from the discount that a long-term customer comes in and asks for, and your sales person gives that discount, to a discount that it's not taken when the oil or the product is purchased, to some additional office expenses, so on and so forth. So for us, and because we deal with the owner one-on-one in these reports, it is one way to definitely get his attention. When we put that as an item all by itself, and then we start running various what-ifs and scenarios, and you can see that number going up and down depending on what decision he has made.
And just, as we mentioned, we have so many energy clients and so much information to pull from that we decided to run through some of them and just kind of give you an average kind of guideline of what we've seen as gross profit percentages and gross margin percentages. So you can see that the average company has a gross profit of around 17.7%, and the average gross margin is, I actually believe those should probably be flip-flop. The gross profit should actually be 22%, and the gross margin should be 17%.
That's right the way it is.
It is? Okay.
Yep, that's right the way it is.
And then also, just as a rule of thumb, delivery expenses as a percentage of sales, it's coming in at around 3.7%, and driver labor as a percentage of sales is coming in around 3%. Now, right now these percentages might mean nothing to you, but when you go back, start running some of your numbers and see if you're falling in line with some of these, because then you'll know if maybe you're not spending enough, or you're spending too much in some of these areas, and it's pinching your gross profit, which is making you, in turn, pinch your margins. Because, again, as I mentioned, the last thing you should be pinching is your margins after you've cut everything else.
Well, that's a word of caution, though. These are averages, so we're hoping that when you do put your numbers together and you're trying to arrive at some of these percentages, that your percentage are better than this, because, of course, an average, that's what it is. It's an average. You've got some, about a half of companies in the study, they're doing better than this, and the other half that it's doing worse.
Mm-hmm. And then in terms of overhead, we've noticed that, on average, overhead has come up at around 9% of total revenues, and as a percentage of total expenses, overhead is made about almost 10%. And on a cents per gallon, we've calculated on average that overhead is costing around 35 cents per gallon. So, you sell $4 a gallon, it costs you $3.50 to buy that. You're already down to 50 cents. Then you have another 35 cents of overhead. That leaves you with 15 cents to play with, and that can either be profit or that can either be what goes into the owner's pocket at the end of the day.
And this is the first time you've seen us also use the cents per gallon. In our study, in our report to management, what we do is we do it both ways. We do it as a percentage of revenue because, as I indicated, banks and third-party users of financial statements want to see it that way. But we also convert it to cents per gallon, because usually that's what the owner, that's his environment, that's what he works with. And so we're trying to convert it in a way that it's more useful to him so that he can see what the actual, once again, what are the implications of his decisions to the bottom line, and how many cents per gallon is he actually walking away with at the end of the day, if any.
And now we're just going to show you, this is just an example of calculating your break-even. As I mentioned, this is a very important calculation that I think every manager of a company should be doing before a heating season, because, again, you want to know, what did I do last year, what am I going to do this year, and what do I want to do in the future? And so it really is a good tool for projecting. And what you need to do is you need to come up with how much your total burden is. And the definition of burden is taking, your total overhead expenses, your administrative expenses. If you have any other income, like interest income or finance charge income, you need to back that out. And then if you happen to have a service department, you need to back that out as well, which gives you what your net overhead is. And then for purposes of this exercise, we like to take out the owner's salary, because the owner's salary can really be a variable on how the company is performing. And so we back it out. We come up with what we call our total burden. And so what you do is you take that total burden and you divide it by how many gallons you did sell, and that tells you what your break-even margin is. So for purposes of this exercise, the company that we looked at, and this slide, the way you're looking at it, is an example of our 5-speed fuel track strategic plan, where we're comparing to a like-size company. So that's why it says your company. In this case, this company sold 1.98 million gallons and had a break-even margin of 54 cents. So that means that if they sold every gallon at a 54-cent margin, they would have had 0 profit and 0 loss for the year. However, if you want to look at it on a gallons basis, you take that burden and you divide it by what their actual current margin is. So that's what they're actually selling their fuel for margin at. In this case, they had an 82-cent margin, so they would have needed to sell 1.29 million gallons in order to break even. Obviously, they sold 1.9, so they were profitable. And because of that, the owner was also able to take out $177,000 of salary. So again, you need to. The good thing about this kind of formula is you can play with the numbers. You can adjust the owner's salary. You can adjust your expenses, and you can play with it, and it'll tell you how much you need to sell each gallon for to break even, and how many gallons you need to sell to break even. And we found that our clients really appreciate this calculation, and a lot of times they have us do it for them so that they can know what they need to do going into the heating season. And if you know how to do it, great. And if you have questions on how to do it, by all means ask. But it is probably the most important tool you can do when forecasting for an upcoming season.
Yeah, and that's a calculation that we normally get a lot of pushback from management, because everyone knows that you can only get the margin that your competitor is getting, and nobody wants to be at a price which is higher than your competitor, because if you do, there is a good chance that you're going to lose revenue and sales to your competitor. The issue with that is that it really is a formula for disaster, because no two companies are alike, and therefore there is no way that you can allow your competitor to tell you what your margins should be. If you do, and you work like that, chances are that your competitor is going to put you out of business. What you as the business owner need to do, you need to know what your break-even is in gallons and in margins, and then you got to then add to that for whatever your salary, your compensation you want it to be, and also if you have any kind of debt, there most likely is some kind of a financial covenant that says the company has to maintain such and such equity, or has to show this much profit. All those things have to be calculated and considered, and then you come up with what your margins should be. And then, as the owner, you got to make sure that you maintain those margins, because if you don't, you're not going to be you're going to be surprised at the end of the year, and usually you're not going to be happy about what the accountant is going to tell you. And it all starts with you. You knowing, you meaning the business owner, you being the manager, the person that is running this organization, knows how much leeway he has with regards to discounts, with regards to giveaways? How much margins can your company give away? How many points give away, and still end up showing the kind of number that will make the bank happy and make third-party users of the financial statements happy? If you don't do this exercise, if you just go and work out of the notion that I cannot have my margins be any higher than my competitor down the street, you're really not going to succeed in this environment.
And as Joe mentioned too about the discounts, if you look at this calculation, if you're going to give a client a discount, it's going to go right to that current margin, which is going to bring it down, and it's going to increase the break-even gallons, which means you're going to have to sell more gallons in order to break even. So obviously, as Joe said, when you're the owner and you're the last person taking money out of the company, every dollar that you give for a discount is $1 less in your pocket at the end of the day. So it's important to keep track of that. And then just some more statistics to throw your way. We've noticed from our client base, we calculate a break-even margin based on size. And as you can see, the more volume our clients have been able to do, the lower break-even margin they've needed to maintain. And the reason for that is because, in theory, your overhead should really be fixed costs. Your rent is going to be your rent. Your repairs should really be your repairs. But if you're doing more volume, then you don't need as much overhead to sustain the operations of the company, because again, those are fixed costs. So again, we've said that volume usually means that you need lower break-even margins, which allows the company to have more financial flexibility. Staying on the delivery end of things, we also want to just kind of show you a quick calculation on how to calculate your cost per delivery, because this can really tell you how much you're making when you go to each delivery. And we know that some deliveries are bigger than others. Some people fill up their tank in full. Some people get paranoid and fill it up after a quarter of a way because they don't want to be stuck in the snow with no heat. So it's important to take this with a grain of salt, but you really just need to figure out all the costs that go into making a delivery, which the most obvious ones are your driver payroll, the payroll taxes, the benefits, the vehicle costs, and the insurance. I mean, that's, aside from the product, that's all you really need to get from point A, which is your factory, your operation, your plant, to the customer house. And so you're just taking all those costs, and you just run through your total number of stops, and that's how much each stop is costing you. So in this case, this company has a $15 per delivery cost basis on fuel, and then you want to see how much each customer costs you. I mean, a good exercise to do is figure out how much revenue each customer gets you, and then figure out how much each customer costs you, and then if each customer is profitable. Because the last thing you want to have is a customer that's not profitable. And as we get into, let's start talking about service and the idea of service contracts, which are very popular, but they're also the easiest way to lose money because a lot of these contracts are structured in such a way that if a customer calls you once or even twice, you already start losing money on that contract. And so we'll get into that, but again, just understanding your cost per delivery can help you establish how much your selling price is going to be, which will also, again, determine what your margin is going to be on that delivery.
And this is, once again, another one of those calculations that we really need to drive it home, because there's been a lot of discussion in the last couple of years in the couple of heating seasons. I know that nobody wants to have runouts, and everybody knows, and the client knows that runouts are expensive. Usually they think they're expensive because there could be a chance that they lose that customer. But they are expensive also for a lot of other reasons. And one is because of the cost per delivery. And so when you have a customer who only wants you to drop 100 gallons because he cannot afford to pay any more than that, and we all understand price of oil being almost $4 a gallon, it is very expensive. Or when they want to sign up as a will call, which means that they're going to have now to pay attention, and they're going to call you when the level gets low. It's human nature, unfortunately, to wait until the last minute, and then they're going to run out, which means you have to go there and go and drop off 5 gallons so that they can get the thing started and then go and make a delivery. All these things play into having, maintaining your costs, trying to contain those costs, and also having the kind of customer that you really want to build your company around it, and that you can make money off of it. There's definitely a lot of customers out there, especially this last few years with all these programs and whatever out there, that at the end of the day, you're really not making any money off of them, and you just got to wonder why are they still a customer? Because if they're only going to be a customer for the 2-3 years while the program is active, and not only that, but they also are causing you some of these other problems with regards to delivery costs and service calls and so on and so forth, you should really evaluate whether that should be a customer to begin with. And the software nowadays, whether, of course, Blue Cow does a great job, and you can get all this information. You can drill down, and you can get all the activity and all the information that you're going to need from that customer or from that household, so that you know exactly whether this is a relationship that you should continue, how much money you're actually making per customer, or this is not a customer that you're making any money. The information is all there. It's just a matter of making sure that it's the right information, and that then once it's there, that you use it. And that's where we really need to do a better job working with our clients to make sure that they understand what they have at their fingertips, because if they do, that will really go a long way towards them having profitable businesses.
And obviously you want to touch on it because it's very important, and I know it's not a big focus of our presentation. It's just the service department, because service is becoming such an important part of your business. There's just things you need to keep in the back of your mind to make sure that your service is profitable, and that's, reviewing all your customers' profitability, which we just talked about. Managing your inventory for parts can be a very expensive task, because parts inventory is very hard to keep track of. A lot of times you have these customers under a contract, and you have your service tech go and just post them from the warehouse, and they don't record it because they just assumed it was covered under the contract. All of a sudden that piece of inventory goes missing, and you just hit an expense that you knew nothing about. The service techs, we tell you to invest in them. They can become your most important people along with your delivery drivers, because we look at them as what we call the front line of defense. They're the ones going out in the field and dealing with the customer. So we're going to talk in a little bit about making sure that they are in line with the company culture, and that they give off a positive image of the company. Another thing, going back to inventory, is playing with a just-in-time system, not leaving a lot of parts inventory on hand, doing your best to buy the inventory as you need it, as you get that phone call for that generator, for that piece of equipment. So again, these are just things to think about.
Yeah, and a general comment there is that as part of our strategic plan, we have talked to a number of companies who, given their geographic area, we can see them 5 years from now being a totally different company. It's almost taking their business plan and their business model and turning it on its head. And what we're saying is that instead of being an energy company, an energy delivery company with a service arm, it's most likely going to be a service company with a delivery arm. So you can see why we believe that getting the service department under control and doing these things and doing all the right things, making sure that you have the right people in that department, make sure that they are well trained, make sure that they know how to handle opportunities, that they are your salespeople, and so on and so forth. It's going to make a big difference. I know in the past that this department has been used pretty much as a loss leader, and the fact was that the margins on the oil side were pretty fat, and you were able to do that. You were able to give the service away. That's why you called yourself a full-service company. And what it meant pretty much is, I'm going to make enough on the oil that I can run a service company and give you the service that you need, and don't worry about how much that department is making or losing. Well, that all changed about 6 years ago, when all of a sudden, as the margins were shrinking, we started noticing that companies were losing money, and it was all the service department. So we're taking a lot of steps to make a marginally profitable or a break-even, And now we're saying we're taking a step further, and we're saying this is going to be the department of the future for a lot of companies.
And as you can see here, looking at these numbers, I think a lot of our clients have done a pretty fantastic job of making the service department a profitable division. I mean, as you can see here, these are all positive gross profits, but they don't factor in the overhead that goes into that margin. I mean, goes into that overall department, so you can't necessarily tell from this alone if it's a profitable department. But on average, the gross profit percentage has been about 35% across the board, both this year and last year, which is up from the last few years. And as we had mentioned earlier, that the service department used to be a loss leader. And also in general, from here we can see that service revenue has been making up about approximately 14% of total revenues. So again, it seems like a little less than 1/5 of the company's operations has been service, and they're trying to keep it profitable. And if you look at the bottom, you see those percentages. Basically, so service gross profit is 35%, materials as a percentage of revenue is 31%, and labor as a percentage of service revenue is 35%. So what that's basically saying is when you structure your revenues, a third of it goes to material, a third of it goes to labor, and a third of it goes to profit. And that's how you should be structuring your pricing if that's how you want to make a profit in that division. And then, again, as we did with cost per delivery, here's another exercise very similar, which is telling you what your cost per service call is, which, you got to keep track of how much revenue your service is making, and then here's your costs. You have, your parts and your materials, your subcontractor, and then sometimes you have, sometimes all the time you have labor. So you take that over to the number of calls you made, and that's what your cost per service call is. You divide that by the revenue per service call, and you can see here that you got $104 per service call, and it's costing you about $78 before overhead. So you have about, what's that come out to, $27 to work with. And if you want to look at it on the number of techs, you have to see if you have too many or not enough techs. Looks like on average you see about 850 service calls per technician is done each year. Or in this case, this company is averaging $90,000 of service revenue per tech. Again, you should run the numbers on your own and see how much revenue each technician is generating you versus how much they're costing you, because obviously you don't want to be caught in a situation where you're paying a tech more than they're generating in revenue. Again, you want your techs to be very billable, always utilized as much as possible, and you need to have contingency plans for when they're not being utilized. And then lastly, on the service end, we just want to touch real quick on designing a service contract. This is just a basic structure of a service contract. I mean, as you can see, the average renewal here is $200. I think a lot of contracts that our clients do fall into this range. And I don't want to get too deep into this, but as you can see, the way this is structured, you're coming out with a $13 bottom line on this particular contract, but you're not keeping in mind that this client could call you never and you make it $13, or this client calls you once and you're down to $6, it calls you twice, you're breaking even, calls you a third time, and now all of a sudden you're losing money on this because all this labor that has to go into servicing that fixed price contract can really hurt you in the end.
Yeah, and that, once again, this is an exercise, a sample exercise that the owner and their accounting people should be doing before they think about what the renewal should be for the following year. Once again, there is plenty of great information available with regards to tracking where the calls are coming from, with regards to service calls, which customer is calling, and it's using that information to set up your contract cost for the price for the following season, and also not offering service contract to certain customers unless they upgrade their equipment. It's foolish for a company to continue servicing equipment which is 25, 30, 40 years old, and they get 10 calls a season, and provide them with a $200 service contract, which then the customer feels that, you know what, since you gave me a service contract, that means everything is included. And all of a sudden, you find yourself that you're really losing your shirt. So it's a matter of doing all this work up front, knowing exactly who your customers are and which ones they should be offered a service contract. Most companies have more than one pricing structure. They may have a basic one, and they may have some other Cadillac ones. So the reason why we are talking about these things and we're putting these examples together in these sample calculations is so that you can go back and sit down with the management team and do these as they specifically apply to your company.
And I know that it's 3 o'clock, so I know that we're about halfway through. We're running late. We will do our best to be efficient and cover the rest of the slides.
Okay.
Take us to the next part of our presentation, which is management and marketing trends. And I know we talked about the need for strategic planning. We're going to just go real quick over loyalty programs. And then, as we mentioned earlier, diversification of your service department. We're going to show you some results from our survey of what other companies have been doing. And then, as I already mentioned, making service techs your front line of defense, because they're the ones going into those homes. They're the ones that were trusted by the consumer who allow them into their home. And if they do a great job and they're happy, then when their neighbor moves in or their person across the street or their friend calls and says, hey, who's delivering your oil, who's servicing you, they're going to say, Joe is, and I like using Joe. And that's how, they can generate business for you because they're acting as salespeople.
Well, we can start with diversification, and that really it's part of the strategic plan that we have been having with a lot of our clients in these last couple of years. And it's a need to find out how to replace those revenue dollars that have actually been lost because of the demand for fuel oil, either because of loss of customers or because the loss due to conservation and some of the other things. So it's a situation where you need to take a look at your marketplace, take a look and ask your customers. Find out, if you really know your customers, you should know what are they looking for, what else would they want from you, what can you sell to them. The basic principle here is that your customer is your biggest asset, and those are loyal customers, and the customer list is worth a lot, and a lot of your competitor or other service providers would love to get their hands on the customer list. So what can the company sell to these customers that they trust you so much, that they allow you into their home, that they know you by name, that they know that you are a local businessman. And the examples that we have seen is, there is no limit to what you can get into, provided that, once again, you do it based not necessarily because you think that your customer may want this, but because you know that your customers want that. And how do you do that? You have to do a market study. You got to do surveys. You got to find out from your clients what are they looking for and what would they want from you.
So you got to ask yourself those questions. What you can take to diversify. I know one of the biggest things people diversify into is propane. But you got to ask yourself, how much is that going to cost up front, and what can you expect? And we've been telling our clients, and it's been pretty sobering to them because they jump on they see those margins on propane and they want to go right after them. And we tell them, well, you need to figure out first if you can afford the investment that goes into it, because in a lot of these cases, when you jump into propane, you're not going to make your return on investment right away.
And that's what we found out a couple of years ago when, after one of those unseasonably warm winters, when a lot of companies were way down in their gallons, they were looking for alternatives, and they looked at propane and they said, wow, if I can make those margins. And so we had quite a number of our clients start looking into propane. But then after we were done with them, and after they had hired us to do a preliminary calculation of what it would take to get into the propane business, and after we were able to show them that it's capital intensive and hundreds of thousands of dollars, especially if you are thinking about storage, and storage is very important because of the distribution issues with propane. Then you find out that a lot of them, first of all, cannot even afford it because they don't have the revenue stream, or they don't have the healthy balance sheet that it's required. And even if they did, and the ones that they did, how long before you can get a return on that investment? Are you able, and will you be able to wait 5, 6, 7 years before you start making any money on this division, on this profit center? It's not the panacea that a lot of clients at first thought, where, yeah, we're going to start making money from day one. Once they got all the answers, a lot of them decided that really propane was not for them.
And so jumping into our survey, some of the most popular revenue streams that we've seen clients do is getting into, tank work, generators, gas stations, seasonal rooms, ice coal, pellets, and then you'll see that there's an other in the middle, which we'll get into. So this slide is just saying, asking yourself, what's your upfront investment? Propane can cost you upwards of almost $500,000 to get into. If you want to get an AC, it could be $100,000. Same thing with solar, and you don't know how many customers you're going to have after 12 months or what your return is after 3 years. Other sources we have, plumbing services. That's been a big thing, plumbing, electricity, getting those trades into the business, because a lot of times you have contracts with those electricians, or they're servicing the same piece of the house that you're servicing. So it's good to get linked up with one of those. Again, we mentioned propane.
In gas, a number of years ago, it was taboo, was blasphemy for an oil company to be servicing or even the mention of natural gas. But nowadays, you will see that there are plenty of companies out there that not only are they servicing natural gas accounts, but they're also offering service contracts, and they're doing installation. And at the end of the day, it makes a lot of sense, because if you didn't and if you don't, you're going to lose that customer for life and forever. But if you are, it's still a customer of the company. Maybe you're not making as much money from them today, but who knows? Who knows what tomorrow may bring?
Yep. And then this is just a quick example of two companies that tried to jump into, or are in the middle of jumping into propane, and two different approaches to it. As you can see, you have to pay up front for the cost of a service truck. You pay for the cost of the delivery truck. In some cases, you're going to want the bulk plant, and then you got to bring on a tech. And in this case, company on the left side did all this in year one, and they lost about $56,000 on it. And that was only because it was a partial year. You look in year two, they still haven't generated enough customers to make it profitable, and they lost $100,000. Now, you look at the company on the other side, they also went into propane, but they took a different approach. Rather than getting a brand new delivery truck, they thought, we'll get a used one, save $100,000 there, and we don't need a storage tank. We'll go take out of someone else's tank. So again, another $160,000 in capital that wasn't necessary to invest. And so it gives you a head start. And as you can see, the losses in the first couple of years are not nearly as significant for the company on the right side than it is on the left side. So again, if you're thinking of going into propane, there is alternate ways of going about it. So you just need to be creative and sit with your accountant and figure out what's the most advantageous way to approach this.
Of course, one, you take a look at the revenue. One after 1 year at $300,000, the other one at $46,000. So it goes into your strategic plan and how fast do you want to grow this line of business. Do you have the time, or will you have to be more aggressive? What are your competitors doing? And that will give you the answer. And
now we're just going to talk real quick about loyalty programs, because as Joe mentioned, your biggest asset is your customer list, and to keep the value of your customer list as high as possible, you need to keep the customer. And to keep the customer, you obviously have to keep them happy. Statistics show that it's less expensive to keep a customer than to acquire a new one. I know everyone's always trying to grow organically, but in an industry like this, where it's really a mature industry, the best way that you're going to acquire new customers is to buy a customer, and it's to not to lose them, because if you gain 12 and you lose 12, you're right back to where you were before. So it's taking advantage of loyalty programs, getting that customer loyal to your company. We looked at a survey that said that the average U.S. household participates in 21.9 loyalty programs, whether that's through their credit card company, through their electric company, through, their health insurance company. Something that gives them points or some kind of value to make them want to stay with the company. Obviously it requires an investment, and we talked earlier about discounts, and we don't want to contradict ourselves, but, it's not always a discount that's going to keep the customer happy. There's other ways to go about it. So you need to find out from your customers, what exactly do they want from you? and what do you need to give them to earn that loyalty? It's not always a discount or a reward. So you need to figure out, sometimes it's just really good service that can get you to where you want to be with the customers.
Yeah, so what you're finding is that a lot of companies are coming to the realization that they try to do so much for a new customer by incentivizing them, offering them all kinds of things so that they can sign them up. And at the end of the year, or at the end of the 3 years, or whatever that program is, they also come to the conclusion that they really didn't make any money. And it's your long-standing clients, the clients that you have had for forever, those are the ones that they really don't complain, don't move, and you really not doing a whole lot for them. And so that's where these loyalty programs are coming about, and a lot of you guys, you companies are getting into these loyalty programs. It's still too early to tell whether they're going to be successful or how successful they are going to be, but definitely there's a lot of time and effort and money that has been put into these programs. I think the idea is a good idea. It's just going to be whether this is something that indeed will pay off for the client.
These are just some types of programs you can look at, discounts, rebates, points. But again, I think the best way to generate customer loyalty is to have service, show them that you really care about them as a customer, that you're happy to have them as a customer, and that you appreciate their business. And honestly, if you can turn your service into sales, then that's less money that you have to focus on advertising and marketing, and you're already paying the tech to do his job. So if he's generating business, obviously you should reward that tech, but also know that, again, it's a cheap way, not a cheap way, it's an efficient way to bring in new business and not have to increase your expenses. Then we just want to talk about collections. Obviously, a lot of times you look in your AR aging and you see you have customers over 90 days, over 120 days, and so the question becomes, how do you get them to pay? Are they ever going to pay, and are they worth keeping as a customer? We've recommended, and Joe just had an article published in Oil and Energy magazine about this, which basically talks about, the idea of employing a full-time credit manager, having a credit and payment policy. You really should run credit checks on your new customers and your existing customers from time to time to make sure that you're able to collect from them. I mean, it's important that you keep a credit card on file to the extent that you can. If every customer was a COD customer, we'd be in a perfect world, but we all know that's not the case. We have something called the 7-10-30, which is the follow-up. If they haven't paid you 7 days after it was due, you should follow up. Wait another 10 days after that, you should follow up. And then after 30 days after that, if they still haven't paid, then you can obviously look at alternative ways to figure out how to resolve the situation. But it's important that when you're going through this process that you document all the attempts that you've made to collect the information from the customer, the payment from the customer, in case you want to decide to take it to the next step. And you can't always be afraid to pursue legal means. I know it's a pain and it's a nuisance, but oftentimes these things can get settled in a small claims court if they need to, but you should really make sure that you're collecting all your money. But you also at the same time need to understand that your customers come from different circumstances. I mean, you could have a customer who's retired and is on Social Security or fixed income, and they only get paid at certain points in the month or in the year, and so you have to wait for them to get the payment. And you just need to understand that each situation with a customer that's late is unique, and so that's how you need to determine how to approach it. But at the end of the day, if you get a customer that's refusing payment and really doesn't have a reason, you have every right to refuse their delivery and shut them off. So you need to, evaluate each customer and whether or not they're worth it to keep around.
Yeah, the process really to address problem customers starts before you even sign them up as customers. And if you do the due diligence up front, you will minimize the number of bad debts and the amount of bad debts that you will have. Every company will have some bad debts. And if we run across a company that doesn't have any, then we question that as well, because that means that their credit terms are such that they're losing revenue. So like anything else, it is a balance, but we also have to understand that things are changing, and you bring it back to a gallon of fuel being at over $4 a gallon, being over $4, and therefore it doesn't take much for a bill to all of a sudden get into the thousands of dollars. One delivery, and that will put you over $1,000. So can the customer afford to pay that kind of an invoice? And if not, maybe they should be in some kind of a program. Then you should be pushing programs so that people can pay over 12 months. There is a lot that can be done. One thing that should be said is that the longer that receivable sits out there uncollected, the greater the chances that you're going to have to write off some, if not most of it.
Yep. So with collections, obviously, comes with managing your cash flow. And by the way, I promise you we are actually almost done. Cash flow, collecting those receivables is a way to generate the cash. You need to also know what your current ratio is, which is your current assets to your current liabilities, because you want to know for every dollar that you owe in the future, how many dollars do you have to cover it. You want to look at your working capital and know how much you have if you want to make investments in property. Sometimes it involves adjusting the timing of your expenditures, and obviously COD is ideal because it's cash in your pocket right away that you can then hold on to, because you got employees that you got to pay to, and managing cash flow is important. I know a lot of clients of ours do the customer pre-buy programs, and they have a lot of advanced payments which they keep on as cash, but you have to know that that's the customer's cash, that's not your cash, and you're essentially acting like a bank for them, and you can't be using that unless you have resources available to support that. The next thing, which I think is pretty interesting, we just wanted to share some industry standards on compensation in the industry, and this comes from our survey, and this is overall for the entire country. We have hundreds of respondents, so this is actually really good information. Based on our survey, these are the average wages that were paid to each type of individual. We noticed we didn't put owners on there because we promised them confidentiality, but on average, drivers across the board are getting paid around $19.56, dispatchers $19.27, service techs $23, and service managers $28. We've had people ask us if we could put payables, receivables clerks on there, and I think in the future when we do our survey we're going to expand that to other positions, because I know there's more than just these people that help keep the company going. And obviously these are benefits. Another thing to look at is how much you're paying in health insurance per employee and your 401k match for your employees. These are great benefits for them, and they deserve it. They really do. But you also need to know if the company can sustain it. I mean, we just went out, Joe and I went out to a client who, great company, losing some money, and the first thing we saw that they were really spending a good amount of money on is the employee match. And we said, how can you be matching these employees all this money when the company's not making money? You need to start somewhere with a cost-cutting measure. So this is always a place we think you have to start. It's really a reward for when the company's doing well, but it's also a benefit that's important to the employee. And then, as I mentioned, we weren't going to give owner salaries, but we can just give you some averages from our internal database of what the owner's salary has comprised of. And so, on average, owner's salary has been around 11% of total overhead expenses. It's represented about 2% of total expenses, 2% of total revenue, and then obviously cents per gallon, which is what you guys understand the most, it's come out to around 11 cents per gallon. Again, as Joe mentioned, this is just an average. Some make more, some make less. So when you go to run the numbers, don't freak out if you're not anywhere near this. And then real quick, we just wanted to touch on target margins. From our survey, the average target margin was 59 cents for the year, which is down a cent from last year. Not that bad, though. And then we wanted to just show you actual margins from our clients. And as you can see, as clients do more and more volume, they're able to increase their margin because they have, fixed overhead costs which support them. And so they're able to charge a higher price. And so overall, our clients had around 67% actual margins, and in both years they exceeded the target. And I know last year was a warm winter, so it was actually good to see that they had exceeded the target even though the target was lower. And for propane, this year the target margin on propane was $1.17, which is up 10 cents from last year. And as you can see from our actual clients, they had much improved margins this current year. Companies that did over 1 million gallons in propane were almost getting a $1.50 margin, which is really good. And so, again, that's part of the appeal to propane.
And as we are approaching the end of the year, no discussion would be complete without briefly touching base on some year-end tax planning. Some of the the item still available to the business is that the Section 179 depreciation, which is that first-year depreciation. And according to the way the law is written, the end of 2013 is when the Section 179 depreciation gets rolled back to $25,000 per year. So if companies have to make major addition to their fleet or to their computer structure, 2013 may be the year to do it. Bonus depreciation will also go away by the end of this year, and so will 15-year depreciation on certain leasehold improvements. So for companies that have been using acquisition of assets to update their fleet or to update their equipment, and they have more to do, you definitely need to reach out to your accountants before the end of the year and see if this is something that you would benefit from. And also there's been a lot of discussions about repairs and maintenance, which it will apply to you as to most other companies. There is still sketchy regulations out there, and it's more to come, but that's definitely something else that you have to talk with your tax preparer before the end of the year so that you can figure out if any changes need to be made to the way you reclassify repairs.
Again,
I think that's
it. So if you want to visit our surveys on gggcpas.com, if you want to look at the results. Again, we have a year-end tax planning seminar, which we just had, but if you want to listen to it, you can go to our website on Thursday, November 21st, and hear it again as a webinar. If you want to learn more, please visit our website. We have calculators on there, an online calculator, a margin calculator. We have a whole energy page designed for just the industry itself. We also have a weekly newsletter, Fueling Our Future, so you can email or contact anyone at Gray, and we can get you on the newsletter so you can get up to date on industry happenings and questions that clients have commonly answered that we answer for them. And if there's any questions, there's our faces in case you're wondering what we look like, and there's our email addresses. So if you have any questions, we'd be happy to take them now, or if you'd rather email them to us, we can obviously get back to you as soon as humanly possible. But